Well, hello and welcome. My name is Rob Reinhold, and I'm the head trader here at Maverick Trading. And we're going to continue our levered ETF series. We're going to be talking about the ticker symbol ERY here. This is the Bearish 2X Energy Sector ETF. Before we jump into how to use this levered ETF, I have to go through what an ETF is, just in case someone here doesn't know what an ETF is.
Whenever you hear the term the stock market, that really doesn't mean anything. Look, there's several different exchanges where stocks are bought and sold on a daily basis and they go up and down. There's really no way to say, hey, how are all the stocks doing? And so they created these things called indexes that you could actually track what the market was doing, like the Dow Jones Industrial Average, the Standard & Poor's 500, the Russell 2000. And they created these as a way for someone to look at this number and say, oh, the market went up today, the market went down today, but it was just a collection of those 500 stocks that they put in there. In 1993, a firm called State Street created the first exchange-traded fund called the SPY, or as was called the Spiders. This was developed to deliver the same return as the S&P 500 index. The great thing about these is it was a stock. It wasn't a mutual fund. It wasn't an index. It could be directly bought and sold like a stock at any time at a really cheap price. This was a great alternative to mutual funds. Before ETFs, if you wanted to get the same return as the market, you had to pay a company probably somewhere around 0.5% or 1% to run the money to try to get you the same return. Now it's as easy as just buying SPY. And these have options, which is awesome. We're an options trading firm at Maverick, so we absolutely love options on these ETFs.
Now, to understand these ETFs, you need to understand what it is they're tracking. When we take a look at this ETF, the Bearish 2X Energy Sector ETF, it is tracking the IXE. This is the Energy Select Sector Index. Now, this is going to track the largest U.S. energy companies. And if you take a look at the weighting of the positions, you can see that Exxon is like a quarter of it, and Chevron is a fifth of it. I mean, these two alone account for about 50% of this index. So these two stocks are very, very important to how this thing moves. And if you take a look at the top 10 holdings, they're basically 3/4 of the whole thing. A fairly concentrated index in just a few names. Now, remember, you cannot trade an index. You can't buy them. You can't sell them. They're not tradable. They're just an index, something you watch. So to trade this, you need to find the ETF. So let's say you want to trade the IXE and you want to trade it, but you want to get a little leverage. So you take your multiplier out, you times it by -2 because you want to play a bearish, and that's going to give you the ticker symbol ERY. The ERY has been designed to return -2x, the return of the IXE. This ETF is run by Direxion, and what they're out there doing is they're out there going long stock, derivatives, futures, and options, and they're trying to get their symbol to deliver -2x of the IXE. That's all they're doing, is they're trying to get this symbol to track -2 times whatever the IXE does. Let's take a look at them side by side. On the left is the IXE, on the right is the ERY, and let's see how well they do. What should happen is they should trade pretty much opposite of each other, which is exactly what they're doing. You can see when the IXE goes up, the ERY goes down, vice versa. When the IXE goes down, ERY goes up. Now look, you can't tell that the one on the right is 2 times levered because the scaling has just been adjusted. And actually, these used to be 3 times levered. And after COVID, these ETFs took stunning losses after COVID. I don't know if you remember, but oil and gas went negative on the futures. You remember when oil was negative $27 a barrel after COVID? What happened is energy stocks collapsed. And so these 3X long energy ETFs, they went down 98%, 99%. They were absolutely killed. And so Direxion said, okay, let's downgrade these ETFs to only a 2X for people's safety. Look, these are still very dangerous. 2X can definitely still hurt. Remember, if something goes up or down 50%, times that by 2, and that's a devastating loss. Let's talk about how to trade ERY safely. Now, we like to use ERY as just a symbol. It's a stock. You can trade it, you can buy it, you can sell it, you can do anything you want on it. So we really like it for intraday or swing trading. this is probably one of the best uses of this, is basically just to use this like you would buy any other stock, but you want to be short the energy sector with a little bit of leverage. Let's take an example of how to just trade these as a regular trade, as a regular stock trade, and see what happens. Here we are in TradingView, and this software has a fantastic little feature called the bar replay. What you can do here is you can come up, click on this replay button, and then you can go back anywhere in the past. Just simply click a mouse, and it takes you to that day, and it doesn't show you anything to the right. So this is where you can go and do some practice trading. So we've chosen a random period in time on ERY, and I'm going to be looking at to be long this. Remember, we don't ever want to go short these ETFs because we want to be just long either the bullish ETF or long the bearish ETF. So if you want to be short in the energy sector, this is a great little symbol to do some shorter term trading. So I'm just going to let this run, and we're going to be looking for a setup. Let's talk about what we're really looking for. Now, we at Maverick, we love to trade trends, and we can see here that we have a 20 moving average crossing above a 50 moving average. We've just made a new swing high. So at this point, prices are going higher. We have no idea how long that's going to last. Yes, we look at some charts, we look at some things, but really we have no idea how long this move up is going to last. So what we need to do is we need to enter at the right times and exit at the right times to make our profit. So I'm just going to hit the play button here. We'll let this develop a little bit. So looking at this technically, here we have the close of the prior day. We've come back down to this point, and we are down to this 20-period moving average. This is a pullback. We like to buy pullbacks, but we don't want to buy this pullback until it actually confirms that it is pulled back. So we need to see a nice green candle that trades above the prior day's high before we even look at taking an entry here. Okay. A little late, but that's okay. I didn't hit the pause button fast enough. Let's go ahead and take this trade. So the trade we're going to take is just a very simple. This is just a stock trade. It's very simple. There's no time decay like you get on options. And we're just simply going to go long here at 56.15. All right, so we're long here at 56.15. Look, every short-term trade needs some risk management, so we're going to use a stop order on this one. So we're going to put our stop down here at, let's call it 52.85. So our stop's going to be right below this last swing low here, 52.85. Look, at this point, we have no idea what the stock is going to do. We did research, we did all this, but in the end, this is what we have to understand as traders. We have no idea what's going to happen. Anything can happen. And so the reason why we use our protective orders, and again, this is just a very basic trade, so a stop order, is to control the risk to the downside. Okay, if the trade doesn't work out and our analysis doesn't work out, what are we going to lose on it before we take our money off the table and just go to another one because that was a wrong one? Okay, great. We've got that in. What we also need to decide is, how long are we going to hold this? How long are we going to hold this? Where do we want to sell it? And how do we want to sell it? At Maverick, we love the idea of trailing stops. We usually pin them to a moving average, like a 20-period moving average or a 50-period moving average, or even a 13-period EMA will be a good exit. I'm making this trade on a 1-hour chart, so I'm looking to make this on a shorter term time frame anyway. So I'm only looking to hold this for maybe a day or two, maybe 3 days. We'll see what happens. But this is the trade. Long at 56.15, I got my stop in. And then what I'm going to do is once the trade is up an amount equal to my original risk. So if I get long here at 56.15 and stopped out at 52.85, that is a $3.30 loss. So that's what we're going to look at if we do get stopped out. What we want to do is we want to use this as a way to move our stop. So once we get a $3.30 gain, which is going to be at 59.45, then what we're going to do is we're going to move our stop up to break even. And then after that, we are going to use the 20-period moving average. So this red line. Once we move to break even, then we're going to move to a trailing stop. Let's see what happens. Again, this is trading. You have no idea whether it's going to go up, down, or sideways. You might think you do, but you don't. But we're just making the bet that we're going to make 10 trades. We're going to lose on some, But if we hold these winners as long as we can, we're going to make a profit over the sum of those 10. All right, and look at that. This is trading for you, folks. We took a loss. We take our money off the table. The trade did not develop, did not move higher, and that's it. We go back to the drawing board for the next one. Using these ETFs as a short-term trading vehicle, very simple, very easy. You're just worried about direction, time frame, and a regular trade. We really do like these levered ETFs for some short-term trading, but we have to talk about the risks because these risks can be surprising, especially to people who are new to trading and don't understand how things work. What I want to do is I want to go through what's called the return differential. Now remember, ERY is attempting to get negative 2x the return of the IXE. So here are the monthly returns of the ERY. Now I'm going to show you the monthly returns of the IXE. Let's take this top month. So in this month, the IXE went up 11.4%. So if you times that by -2, you would say, oh, then this probably went down by 22%. It didn't. It actually only went down 15%. So it actually did a little bit better than it should have. However, we take a look at the next month. Okay, the IXE went down 10%. So if it went down for 10%, then the -2x should have gone up 20%. Nope, it didn't. This is what's called the return differential. And basically, this is how well Direxion has done to get this thing to track. Now, I broke down all these past months, and you can see that most of the time the differential works against you. And the worst one was in September of 2022, where you got a -10% differential. Now, this isn't a bad set of numbers. We've taken a look at a ton of ETFs here at Maverick. We've made lots of videos on these, and this is not a terrible differential. It's not a great differential, but this is something you don't really need to be worried about on this one. We have other levered ETFs where the differential is so bad, we basically tell our traders, don't trade these. These are horrible, horrible products because you're not really even getting close to the same return. This one is decent, but you need to understand that sometimes you're not going to get 2x the return. Sometimes this is going to fail a little bit and you're going to underperform quite a bit while taking 2 times the risk. Another thing we need to talk about are the fees. Yes, there are fees on these. There's about a 1% annual fee, and every single time you click this button, you're going to be paying a fraction of that fee, where other ETFs are going to be much cheaper to buy as far as fees go. And the other thing we don't really love about these is there's no options benefit. We are an options trading firm at Maverick, and so we love options, and options just don't make sense on these levered ETFs. The reason why is that the options market is smart. If the options market knows that something is twice as volatile as the symbol it's following, all it does is make it twice as expensive to buy those options. If it's a 3x ETF, all it does is makes those options 3 times more expensive. So it's the same trade. It's the exact same trade. There's absolutely no options benefit to trading options on the levered ETFs themselves. And in fact, there is actually a penalty because the bid-ask spreads are going to be much wider and you're going to have more slippage. So in the end, they're going to be more expensive to trade. If you want to do options trading on energy, that's in capital, all options trading should be done on the 1X long energy ETF, the XLE. This is the one with the most volume. There's penny spreads. There's lots of liquidity. Just do all of your options trades on this. It's the same thing. If you do a bear call spread on the XLE, it's literally the same thing as doing a bull call spread on the ERY, but the one on the XLE is going to be way cheaper to do. Again, there's no benefit whatsoever to trading options on these levered ETFs. And then the last way we really like this, and I think this is probably the best usage of this one, is to use it as hedging. These levered ETFs are great to use for hedging. Let's go through an example of how that will work. Let's say there's somebody who was holding 50,000 long of energy stocks. All right, they've got some Exxon, they got some Chevron, or maybe they just hold 50,000 of the XLE, the energy ETF. And then some news comes out, and the news says that there is something happens in the oil market, there's oversupply, and oil falls, and all of a sudden there's a big panic. Now, look, the trader doesn't want to sell these for some reason. Let's say there's tax reasons. Let's say they've got a different time horizon. But it's pretty clear that oil is going to pull the energy sector down. What this trader can do is they can simply go over and buy 25,000 of the ERY. At this point, they are basically hedged. So let's say that energy stocks fall about 10%. So they'll lose $5,000 on their energy stock portfolio, but they went long 25,000 of ERY. ERY goes up around 20%. They make about 5,000 over there. As you can see, this is a way for someone to go in and hedge out their energy stock exposure. And it's a really simple, easy way. There's no time decay to worry about like with options. It's a very simple directional hedge. There's lots of great usages of these ETFs. You can use them to protect things. You can use them to aggressively trade things. But let's talk about the risks. The biggest risk of these is position sizing. Everything is simply as simple. And some symbols move faster than others. It's like jumping in a car. If you jump in a slow car, there's going to be a little bit less risk than if you are in an F1 race car. Obviously, your skill level is going to determine how well you do, but position sizing for newer traders, they don't understand how quickly these things can move. Now, I told you about how these were 3x ETFs at once. These 3x ETFs lost 98% of their value in about 3 weeks in 2020. If you didn't know that and you were over leveraged in it, you're gone. You wiped out your entire portfolio if your position sizing was too big. So make sure you have really good position sizing. Understand that these things can move. Energy can move 20% in a week. I've seen it do it. That's a 40% loss. Did you position size enough to where you can handle that kind of loss? The answer is no, then it's really going to hurt. So always have proper position sizing. Let's go ahead and wrap this up. We really do like ERY as a short-term trading vehicle. When you just want to be very simply short energy and you don't want to worry about options and all these other things, look, just go long ERY. If you want to be short inside of your IRAs and your retirement accounts, these are allowed because you're not shorting them, you're buying them. So go ahead and buy ERY. Remember, all options trading, do not do it on the ERY, do it on the XLE. That is the best way to do it. You're going to get the tightest spreads and the lowest costs. And hedging is just a great way to use this one. ERY, if you've got energy stocks in your portfolio, they're working against you, you think you're going to have to sit through some pain, throw on a hedge. Go in and buy some ERY, hedge that out as they drop. ERY is going up in value and you're not losing as much, or you might even be making a little bit off of the difference in the hedge. That is how to trade ERY safely. Thank you so much for joining me. Again, this is Maverick Trading. See you later. Goodbye.